And let's take a look now at market liquidity, the Fed rate hikes, and how investors can position their portfolios. Joining us now, Lynn Alden, founder of Lynn Alden Investment Strategy. Lynn, I've been following your work for quite a while, so I'm so glad that you're with us on Yahoo Finance.
Thanks for having me. I'm happy to be here.
So let's take a look at liquidity, because I know that you watch this, and central banks, except for the Bank of Japan and for China, have been withdrawing liquidity from the system. Talk to us a little bit about what this does to the financial plumbing and the markets overall.
So right now we have two major opposing forces in liquidity. The Federal Reserve, because they're reducing their balance sheet, are pulling liquidity out of the market. And that basically means that rather than them buy the bonds that are being issued by the government, the private sector has to buy those bonds. And they're letting bonds roll off their balance sheet. And so there's actually more bonds entering the market than there would be just from issuance alone. So that's a liquidity drain on the market. And historically, that's not very good for most asset prices. On the other side of that, you have the Treasury General Account that has generally been draining since the middle of last year, and that's actually a net positive for the market, because basically you can imagine as money is kind of stuck in their cash void, it's not really being used, and as they draw it down, it goes back into the market. And one of the reasons they're drawing it down is because of the upcoming debt ceiling impasse. Because they're unable to issue new bonds, they instead have to do extraordinary measures, such as draw down some of their existing cash balances. And so that's actually been somewhat of an opposing force. And so if you look back last year, you had falling liquidity for most of the year. That was in line with the market continually going down. And then starting in the beginning of quarter four of last year, you've had more of a sideways liquidity environment because of these opposing forces. And so it's not surprising you've seen kind of a choppy sideways market ever since then.
Let's talk a little bit about the Fed meeting that's going to happen this month and the expectation of a 25 basis rate point hike. Some are maybe expecting 50 basis points, but nevertheless, as far as the Fed's goal to bring inflation down to 2%, do you see that happening?
I think it could happen temporarily, but I think they're going to have struggles doing it longer term, because it's another area where it's being opposed, right? So tighter monetary policy can reduce some of the private sector activity, right? Obviously, very interest rate sensitive industries such as housing, such as unprofitable tech. These areas are obviously slowing down, fewer workers, overall less consumption, less activity, deflationary asset prices. That's in line with their goal. On the other hand, because we're still running these background pretty large fiscal deficits that actually grow larger as interest rates increase, because the government's paying more interest on its existing debt load. That's actually a background inflationary force, because that's more money that's going into the economy. And so I actually think that when you look out several years, they can temporarily get inflation down if you have a recession or a pretty severe kind of a slowdown in growth. But anytime they want to have a reacceleration in growth, I think inflation is likely to return. I think that's probably going to continue until either you bring in a lot more energy production globally, or they rein in the deficit as a percentage of GDP to a significant degree.
So how should investors position their portfolios?
So I think this year you have to kind of expect a choppy, sideways, rough market. We have yield curve inversion, a number of potential recession signals as you look out longer, but you do have this kind of neutral liquidity environment. So I think T-bills are attractive. I think money markets are attractive. And if you're looking at the equity space, I think there are interesting income plays in, for example, energy pipelines, healthcare stocks, basically assets that are cheap, that are pretty high yielding, and they're not likely to be very sensitive to ongoing economic deceleration.
The energy market hasn't done so well when we take a look at energy equities. So you said energy pipelines. I mean, are there specifics? Is this a stock pickers kind of market?
I do think you have to pay attention to individual names you own if you want to have the best results. And for example, there's a pipeline company, Enterprise Products Partners, ticker symbol EPD, and they, for example, have very long duration fixed debt, and so they don't have a lot of the refinancing risks that you might see elsewhere. Also, they make most of their money with fees rather than product sales, and so I think that's a kind of an attractive place to be for, say, a multi-year view, and they can hold up pretty well even in a recession scenario.
Great insight, Lynn Alden, founder of Lynn Alden Investment Strategy. We'll have you back on again. Thank you.